Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. Hello, I'm Greg Milano, founder and CEO of Fortuna Advisors, and I'm joined by my business partner, Marwan Karame. Welcome to our third LinkedIn Live episode. We've enjoyed this platform for sharing some of our views and our expertise, and we hope you enjoy the episodes as well. Like the previous two, this episode will be repurposed as an episode of our Create More Value podcast. I encourage you to listen to a lot of the interviews we do on Create More Value podcast. But for this one, since we use slides, we recommend viewing it on YouTube rather than as an audio-only podcast. Today, we're going to discuss one of my very favorite topics, strategic resource allocation, which is the allocation of capital and other strategic resources across a company's business or product lines. Investors frequently complain that the companies they invest in do a poor job of capital allocation, and based on our experience, they're justified in this feeling since most companies are pretty bad at it. If you want strong total shareholder return, or TSR, get better at allocating resources to their highest and best use. So to begin, let me set the stage with some context around capital deployment at its highest level. First, consider the sources of capital, which include cash produced by the company's operations, cash that may be raised by issuing debt or equity financing, or cash that may be thrown off by companies' non-operating investments. The first question is, do we have attractive investments? By which we mean investments that create value by generating more cash than they need to deliver the required return on capital. If the answer is yes, our priority should be to invest in everything that creates meaningful value, including capital investments in property, plant, and equipment, P&L investments like innovation and brand building marketing spend, and strategic acquisitions. If the answer is no, we have a related follow-up question. Do we expect to have value-creating investment opportunities in the future? If the answer to that question is yes, for example, if the market is so high that acquisitions don't look attractive now, but in the next downturn we may want to buy another company, then we want to build financial flexibility by paying down debt and holding cash. If the answer is no, perhaps because we're in a declining industry, then distributing capital should be the priority. Today, we are focusing on the optimization of the allocation of investments that aim to create value so that we create as much value as possible, the lower left-hand part of this graph. So despite his retirement, we still like talking about Warren Buffett, one of the greatest investors of all time. And we asked the question, what would Warren do? Investors concentrate capital in stocks they expect to rise and withdraw it from those they expect to be flat or down. Great companies allocate resources the same way. They think this principle is so obvious, they look at us like we have four heads.
I can testify that I've seen this and witnessed this with Craig several times. And quite frankly, though, he's been vindicated each time with many of the client engagements that we have. And so we see this especially when we look at companies from this particular lens, which is we take a look at the reinvestment rate, products of business units. And by reinvestment rate, we mean the percentage of profit that gets reinvested back into each of these business units or products or segments, market segments. And we compare that to the residual cash earnings return, basically trying to come up with a measure that shows your bang for your buck. And from the last two episodes, we talked about residual cash earnings, which is an enhanced version of economic profit, a cash-based version of economic profit. We look at the incremental changes in that measure divided by the amount that's been invested. So you get a really good sense of where value is being created per dollar of investment. And pretty much every single time, we find that the pattern that we see and the profile is one where people are investing actually in things that destroy value, more amounts of profit being invested in things that destroy value versus creating value. What we want to see, though, if you take a look at the right graph, is the opposite, obviously, right? Taking more of the profit, investing in the things that are actually going to create profit, and move resources away. And when you do that without adding any additional capital, you can actually create tremendous amounts of value creation. And this example is actually from an actual example with a client, a consumer goods company that did this very thing and made a huge difference for them. One of, I say, there are many reasons why they do that. And I think Greg has done a really good job summarizing some of the biggest failures that companies have and why it results in these type of patterns.
Just before we leave this and go to the next page, I just wanted to say, so what happened in this case with this client was kind of interesting, because the graph on the right comes from a top-down reallocation of resources that we did with the corporate finance and corporate strategy people. We took the plans that have been submitted, which is the left side of the graph, by the businesses of the company. We reallocated about $3 billion of resources. Some of it was capital, some innovation money, some marketing money, from away from the businesses on the left that were destroying value and toward the businesses on the right that were creating value. When we moved those $3 billion of investment, the NPV of the company went up by about $9 billion. So the consolidated plan went up by about $9 billion. And that was really powerful, right? So then we went out and we shared that at an offsite with the senior management of the company and tasked everybody with doing a new bottom-up plan. And when we got all done, they only reallocated about half what we did, or about $1.5 billion. They had trouble pulling money away from some of the poor businesses, so they couldn't increase the investment as much as we did in the good businesses, while keeping the total company investment the same. But still, the NPV of the company's plan went up by about $4 billion. So, this is pretty high impact stuff that can really dramatically change the amount of value creation by concentrating resources where they create the most value. So as Marwan said, I wrote this article with Jim McTaggart. Jim's a good friend. He was co-founder and the first CEO of Maricon Associates, a very successful value-based strategy advisory firm. And he's been a senior advisor at Fortuna Advisors for a long time. In 2018, Jim McTaggart and I wrote this article, Overcoming 3 Roadblocks to Strategic Resource Allocation. And we'll elaborate more on the coming pages. But the biggest obstacles to effective strategic resource allocation are erroneous objectives, a lack of focus, and decision paralysis. Marwan, you want to talk to us a little bit about erroneous objectives?
Yeah, no, I think that sets the foundation of some of the failures that you see within organizations. A lot of times they have way too many metrics that they're evaluating to try to make these decisions. And when you manage to everything, you manage to pretty much nothing. And so they have a tough time achieving any of the goals that they have in terms of their objectives or metrics. And it really comes down to focusing on the main thing, which is creating long-term value, right? And as Stephen Covey has said very smartly, the main thing is to keep the main thing the main thing. So the question now is, what is the main thing? How do you measure value creation? And it's best measured through residual cash earnings, which we discussed in our last episode. But it's effectively a cash-based measure of economic profit that takes into account pretty much all the trade-offs between all the other metrics that you might look at. And you can see this actually empirically when you look at companies that have achieved the top quartile and see what metrics they achieved top quartile as well. Residual cash earnings will give you a higher probability of generating top quartile TSR performance when you perform at top quartile performance with residual cash earnings. And this has been consistent versus any other metric. Residual cash earnings over the last 3 years, which is when we started the study in our value leadership report, has always maintained the top spot. Return on invested capital, you can see, sits at second place. But it always wasn't like that. 3 years ago, it was, basically at the same spot as revenue growth, and revenue growth had taken the second spot. So This now provides a tremendous amount of clarity in terms of what to focus on. And you have a singular measure now that helps to overcome the next challenge, which is lack of focus.
So few companies have a clear line of sight into where and why long-term value is created. And it's really important to have that line of sight in order to be able to really make smart decisions about, where to allocate resources. Knowing where you create the most value is really important. And, people really don't use the right metrics. They use contribution margin and things like that when they're looking at different product lines and different parts of the company. We need to look at value creation. It's really important. And we need to understand why we're creating value. I think, it's really interesting. I thoroughly enjoy asking finance folks, what are their company's competitive advantages? And, you get some really good answers from people, really articulate, well thought out answers, but you also get some blank stares. Lots of times the finance people don't think enough about why we create value. It's really important to understand that because, of course, you want to be investing in those differentiators, those competitive advantages that give you the benefit of being able to create value. So we'll explain a little more what we mean by that, on the next page, in 2 pages actually. So first, it's basically the 80-20 rule. Okay, the Pareto principle. 80% of the value is created by 20% of the activities, and you need to concentrate resources where there's the biggest bang for the buck in those areas where you create a lot of value. Right. Most companies spread resources like peanut butter, a little bit here, a little bit there, but they should concentrate them where they do the most good. And that's really what Warren Buffett was talking about here. He's talking about how you invest in the stock market, but it's exactly the same principle as how you should invest, inside your company as well. So this visualization is a really important one. This is an aid to help you understand what we mean by a value creation fact base. And I know it looks like a Rubik's Cube. The first client we used this with about 7 or 8 years ago, kept saying that, but it actually makes the point really clear. So in this particular case, I mean, every company is different. Every company has a different business model. But in this case, it was best to look at the business by customer type, by product category, and by geography. And when you look at those different dimensions, you can now look at a particular dimension. Like in this case, let's imagine it's the sale of product category A through big box retailers in Germany, right? Do we create value there? And you replicate that for all the other boxes, and you start to really get an understanding of where value is created. And you need to do this on a fully allocated basis. You need to really be looking at residual cash earnings to see if value is being created. And this way you can concentrate the resources in the areas with a lot of confidence that you really do know, where value is being created. Understanding why we'll cover now on the right side of the page. And it's really quite different from this left side. First, we start with what is the perceived value to the customer. So let's say you sell accounting software and it enables a company to grow without adding as many accountants. So they can calculate what is the reduced salary and related cost that they would have incurred had they had to hire more accountants that they now don't have to do, and that they can understand the perceived value very well. In some cases, it's not as easy for somebody to understand more that precisely what the perceived value is. But the important thing is when we compare the perceived value to the price, the difference is what the economists call consumer surplus, but that's like the value that's in it for the consumer. They're getting something that's worth more to them than what they have to pay for it. That's what attracts them, to buy it, in the first place. We compare that price to the total cost, including the cost of capital, the way we calculate it in residual cash earnings. And the difference between the two is value creation. That's the RCE, the residual cash earnings that we've been talking about. And again, Marwan said it, but the prior episode of linked on LinkedIn Live, also one of our podcasts, is all about residual cash earnings and the value of it relative to other measures. Now, when companies look at this, they face challenges, they face pressures that try to steal away that RCE. Competitors are trying to push price down, right? The competition from competitors, and suppliers and employees are trying to push cost up, right? They're trying to raise their prices or salaries or what have you. And so there's pressures that are trying to take all the value away. And your defense against the erosion of that value creation are your competitive advantages, your brands, your technologies, what have you. People will pay a higher price for a Coca-Cola or a Pepsi than they will for a Publix brand cola. and that brand, and the taste perhaps is a reason why the person perceives so much more value in that, and they're willing to pay that very high price. And the same is true in any business. If you don't have competitive advantages, you're going to struggle to create value no matter what your industry is.
Yeah, I think one of the benefits of residual cash earnings also worth noting, and it sets itself apart from some of the other measures that you'd look at. It can actually quantify how much of the value is being created through growth contribution due to differentiation and pricing power, or through efficiency improvement by the changes in margins, really because you're managing suppliers and the costs, effectively. And that ends up then leading to a very disciplined, fact-based approach to strategic resource allocation and portfolio optimization. And that's really tough to do with other measures because they only speak to either scale or quality of investments, but not both. And a great example of that actually is return on invested capital, as an example of a metric that can't speak to both necessarily.
So before I go to the next page, I want to address a question that's come up. So when you look at this left-hand page and we're talking about calculating residual cash earnings by customer type, by product category, by geography, or maybe even deeper than that. And the question is, how difficult is it to do that? And it's true, most companies don't have the information readily available to look at this, sort of deep level of profitability. But depending on the company, the way to do it is different, but it's not impossible to pull together the information to be able to allocate all the costs and allocate all the capital. It's basically activity-based costing. And at the end of the day, we're not splitting hairs. We don't care if something creates a little bit of value or destroys a little bit of value. We're looking for that 20% that creates 80% of the value. And we're looking for the ones that are really destroying a lot of value. And for those ones at the top 20% and the bottom 20%, you can allocate the cost and capital pretty loosely and you're going to get the right answer. It doesn't have to be that precise. And so, exporting data from systems and putting it into spreadsheets, there's also some software packages available for doing this sort of thing. But it's not really that hard to do. And it takes time. It's not easy to do. It takes expertise, but it's not impossible. Companies shouldn't be afraid of doing it. The insights you get are worth it. Again, if you go back to the example before, the MPV of the company's plan went up by $4 billion. And I assure you, the amount spent on us and on the internal people working on it, was a very, very, very small percentage of that. The ROI of that investment was huge. And even for smaller and mid-sized companies, the ROI is pretty high on doing this. So it's something that we definitely encourage people to do and to take seriously. If you're relying on things like contribution margin or gross profit margin or something like that, you're going to be wrong. Okay. So Marwan just made the point about rates of return, which actually segues really nicely into the next slide. But if we go to the next slide, this is another client case study, and these numbers relate to return on capital for their three business units, which we've named here business units 1, 2, and 3. And business unit 1 earned about a little more than 4 times the required return on capital. Business unit 2 doubled the required return on capital, and business unit 3 just had a small margin above the required return on capital, which, by the way, was a little under 10%. So you can kind of see those numbers. And so we looked at this and we studied a bunch of things about the company and the competition and the market and so forth. And all of it pointed to the same thing. The company should be pouring a lot more investment into business unit 1. Really, really important that they focus their investments in business unit 1. It had the best runway for growth, and it had the highest amount of value creation per dollar of investment. So when we told them that, they should grow this high ROIC business, the corporate people we were working with told us, we've asked that business unit for years, but they just don't have many good investments to make. So that's why its growth is stalled. And so we said, okay, we didn't understand that, but it surprised us, but we didn't push back. Some months later, we wound up meeting with the leadership of the business unit, and they laughed and said, we have plenty of good investments, but it's hard to find any with high enough returns to improve on our 43%. And we realized the problem was they were measuring return on capital and paying people to improve it. Now, in a vacuum, it seems like paying people to improve a return on capital is a pretty good thing. But if you've already got a 43% return on capital, finding things that make that higher requires you to invest only in things that earn more than 43%. Your hurdle rate becomes your return on capital, which for the business unit one was really, really high. If you invest at 30%, it's going to bring down the average. Even though 30% is more than 3 times the required return on capital, they would be discouraged from making those investments. They were discouraged from making those investments. You could have the situation, which very perverse situation, where business unit 3 is making investments at 15% and improving their return on capital, and business unit 1 is turning down 30% return investments because that would hurt their return on capital. It's just a really, really bad situation. So although return on capital is a very good measure, because it measures quality but not quantity, it can lead to very bad behaviors. And it's one of the reasons why people overinvest in their poor businesses and underinvest in their strong businesses, just like the bubble chart that Marwan walked you through a few pages ago.
Yeah, that actually reminds me of what happened with Coca-Cola. For the longest time, they would not invest into new products because it was going to deteriorate their return on invested capital. And it wasn't until Roberto Guazzetta came in and started to apply the concepts of economic profit, what we do with residual cash earnings, and came out of the gate with, I think it was New Coke. That didn't go so well, but then they reinvigorated Coke Classic, and then they came up with Sprite, and they came up with these other products that had lower return on invested capital than their original product. And as a result, they started to actually do quite well, and Coca-Cola exploded from then on. I think leading to Warren Buffett being a big investor in that company as well. And I think that then leads to this whole decision paralysis. If you're not having the right measure and looking at value creation in an appropriate way, it has weak links and accountability to actually generating value creation. Whereas when you actually have a singular measure that gives you focus, that embodies all these other measures and really embodies value creation, then you get you have the ability to actually make decisions and develop strategic options to allocate resources in a very disciplined and paced manner. And that really, it's funny, recently having a discussion with the former CFO of Varian Medical Systems at their offsite meeting at the new company that he's now the CFO of. He was telling the story about how himself, the CEO, and the CFO at the time had an acquisition. It was with Certex for $1.3 billion on the table. They were going to make the acquisition. A suitor came in, offered 15% premium over and above their offer. And with basically 15 minutes, they were able to figure out that to match that offer, they wouldn't be able to generate the profit to exceed the capital charge associated with it. And they set it aside. That allowed them to take that amount of capital to then reinvest in actual acquisitions that were going to grow value, put a ton of money back into the business in terms of R&D, where they got a tremendous amount of value, double their share price within 2.5 years or so. And before they got acquired by Siemens Healthineers and did very well for shareholders. So that really stems to the next, message, which is with residual cash earnings. For many companies, they're looking at a litany of metrics for many different applications, whether it's goal setting, pricing, what have you. And to be able to just look at one metric, residual cash earnings improvement, which embodies all these different metrics and can be applied to all these different applications within different functions, you get this singular measure of performance that creates a common language within an organization, allowing you to make better decisions, both with discipline and pace. And then if you link it to incentive compensation, where you make what's good for investors in the company also good for employees and their managers, then you really get a ownership culture that starts to evolve within an organization, which then leads to something we discussed in the last episode, which is the 5 traits of an ownership culture. You see employees and managers spend money like it's their own. They start to think about extreme prioritization, concentrating investment in the places that are going to really move the needle in terms of value creation, taking risks, but taking it thoughtfully, doing more and talking less, and then thinking about both the long and the short term when they're looking at the company.
Just before we go on to the next topic on this decision paralysis point of view, I just a little story from my past. In the 90s, I lived in London and had clients across Europe, and we had one client that did very well. And it was a large conglomerate on the continent, and they did very well, did a lot of things. And I remember talking to the CFO after a great run in their share price. Their share price more than doubled. And I said, how much of this you think was related to the work we did for you? And he said, many of my colleagues would say not much because most of the big things we've done in the last couple of years were already on the drawing board before you got here. He said, but I would give you like half the credit because we just kept talking and talking and talking. And, with the value-based framework, and in particular, the value-based incentives, you created a sense of urgency to actually do things. And we pulled the trigger on a lot of things that, we used to just meet and come up with more things to study, and we'd meet again in a few weeks, come up with more things to study. And that sense of urgency increased the pace of decision making. And a lot of the stuff, really, really happened and happened quickly. So the ownership culture can have a really big impact. So one more point about this is strategic resource allocation, or SRA as we call it, has to be an ongoing and dynamic process. One of the problems for many companies is they only think about this once a year when they're doing the planning process. But if new unexpected opportunities come along mid-year, they have to wait for the next planning cycle, and they can lose valuable time. So we like to use this graphic, which one of our former colleagues, Joe Terrio, made many years ago, and still one of my favorite slides that we've ever used. But imagine that this is a prioritized list of investments from the left to the right based on how much value they create per dollar of investment. And we're sitting there going along and we're saying, okay, these are the priorities. A couple of boxes that are above the line are colored white because the company maybe has limited resources. They've got a lot of debt and they don't have really good access to funding right now. Maybe the market's down. They don't want to dilute themselves too much. And so they decided to put a limit on how much they could fund. And so the white ones are not funded. The ones below the line, of course, are not funded. And the blue ones are funded. Now, middle of the year, a new acquisition comes along that slots in nicely and looks really good for value creation. It pushes everything else to the right. And you'll notice one additional block turned white. So in order to be able to fund the acquisition, we can't quite do all of what we were planning to fund before. And so this has to be a dynamic process. If you waited to the end of the year, maybe somebody else would make the acquisition. It's no longer available. Or if it's maybe an organic investment, if you wait till the end of the year to the next planning process, by then maybe a competitor beats you to it or something like that. So this needs to be a very dynamic process where people are sort of living and breathing it all the time.
So, I mean, getting started with strategic resource allocation really starts with understanding where value is being created or destroyed. And then after that, assessing whether it aligns with value creation. From there, you want to then shift resources and concentrate resources, not just diversify or peanut butter spread the allocation across all the different activities that you're doing, but actually focusing it to move the needle. And then finally, where there are investments or activities that aren't creating value, give them the chance, or the right to grow, earn that right to grow. If you can't fix it, then take bold decisions and look to deploy that capital elsewhere. And then what ends up happening at the very end is you want to start to institutionalize this process so that it becomes part of the organization's way of thinking.
We got a live comment here that I wanted to read out, and then maybe Marwan, you and I can talk about it. So governance processes should require investment decisions of business units to be elevated to higher corporate level review to ensure decisions are in the best interest of the overall organization and not sub-optimizing for the sake of a business unit. Just a couple of thoughts on this, and then Marwan, maybe you have some thoughts also. I understand the point that's being made. Unfortunately, if you take that to an extreme where every time a decision has to be made, it has to go to corporate to make sure it's in the interest of everybody, you wind up really slowing down the decision process, and it often, unfortunately, becomes very bureaucratic and political, and resources wind up being allocated where, based on who knows who rather than how much value is being created. What we find is that, if you've got good transfer pricing internally, and you've got incentives in each business to create value by increasing RCE, where you directly tie, and we're going to do one of these totally on incentives in the coming months, but you tie incentives to the improvement in RCE, which is like giving each business unit their own share price. But you also tie, let's say, 25-30% of their pay to the consolidated improvement in RCE. You tend to encourage people to be accountable and make the right decisions. Sometimes it's a little more corporate if more teamwork is required. Sometimes it's less based on corporate RCE if you really aren't that worried about teamwork. Each business is an isolated island, but you can calibrate that to try and get the right balance of local accountability and teamwork without having to slow every decision down to some kind of a series of corporate meetings. So having said that, I've seen too much incentive to perform your own business and get at just the problem that this listener has raised. So you have to be careful, and there needs to be oversight. But we like decisions to be closer to the source whenever it's possible, as long as we have that incentive accountability. So if they destroy value, some of the value they destroy is their own. Any more comment on that, Marwan?
No, nothing to add. I think you did a great job on that.
Okay, so if you would like to receive, we've ended each of these LinkedIn lives with this. Got a couple more questions I'll get to, but since we turned to this page, I'll keep it to this. So we were recognized by the Journal of Applied Corporate Finance in their volume 36, number 4, by a special issue called "In Honor of Fortuna Advisors." We think it's a great honor of our thought leadership and our contribution to the field. All of the articles are written by our people, or they were roundtables, largely led by our people. And these articles collectively provide a lot of our insights on, capital allocation, how to drive better decision making, value-based management in general, and so forth. And I will call your attention to the 2 capital deployment roundtables. One is generally on capital deployment, and the one second from the bottom is specifically on intangible investment, like investing in technologies and brands and employee training and all kinds of things that get expensed instead of capitalized. That was a really good conversation also. But I think, there will be, for anybody who would like a copy of this, just email us, say JACF request live LinkedIn in the subject line, and send it to info@fortuna-advisors.com. And we will get a copy to you. I think you'll enjoy it. And thank you. But before we part, we want to just go over a couple more questions that came up. So one of them is here. My company went through something like this once, and what we found was it was a lot easier to find areas to increase investment than it was to find areas to decrease investment. And so the process wound up, driving up the total capital budget. What do you do about that? Well, I guess the first point is you shouldn't be driving down investment if it creates value, unless, like that one example before, we're cash constrained because of our balance sheet. So you got to be careful about setting arbitrary limits on investment. But I also think a lot of the reason why it's tough to reduce investment in the sort of weaker value creators or even the value destroyers is because incentives aren't aligned correctly. If people are being paid to produce EBITDA versus their budget or something like that, and it doesn't matter if they're destroying value, as long as they plan for it, then it's okay. When you pay people to improve residual cash earnings, if they make investments that don't cover the required return on capital, then RCE goes down and they get paid less money, because we're always measuring it against last year. We're not measuring it against the budget. And so all of a sudden, once you put that kind of an incentive in, if people are making investments that are not producing returns that are meaningfully above the required return on capital, they volunteer often to stop making them. They realize that they'll make more money themselves if they stop making those bad investments. And so, it's really, really important to align incentives to get this kind of behavior that we want. When you do that, it becomes easier to reduce, the resources allocated to the weaker businesses, and that creates funding for then, really concentrating the resources in the best businesses.
Yeah, I also think that another component of that is just not having a fact base to compare the different, investments. They'll look at it independently. It's driven more politically, especially the ones where you're going to, shut down a business or divest. Very tough to do unless you have a pretty solid foundation in terms of the facts and where things are being accretive to value and destructive.
Yeah. Once people see the fact base, they're just, the decisions become much easier. They don't need the peanut butter anymore. Another question that came in was, you mentioned M&A early on, but then didn't talk about it anymore. How does M&A figure into your strategic resource allocation framework? And how do you prevent overpaying for acquisitions? And I think it's that kind of the same thing. And it goes back to Marwan's example from Varian. They were about to make an acquisition. They were in contract to make an acquisition. And then, somebody else came along and bid, a lot more. And instead of just raising the price to make sure they win, they looked at it and said, wow, at that higher price, it's not going to create any value. We're going to be giving away all the value to the selling shareholders. And so they walked away and took a breakup fee. And, that discipline was largely because they had this value-based incentive plan that really encouraged them to be disciplined. Now, there's no guarantee you're ever, any investment you make is going to create value, but you're more likely to be objective in your thinking about it if you're exposed to the outcomes than you are if you're not. And if you're measuring any measure of revenue, profit, any measure really against the plan, then you don't have accountability, because as long as it's in the plan, it doesn't matter if it's good or bad.
Mm-hmm. Yeah, absolutely.
And the last question that is on here is, how do you think about distributions versus reinvesting capital and acquisition? So distributions being like dividends and stock buybacks. And I don't know, Marwan, you want to give a comment on that?
Well, I think it's some of the work you did. I was going to send it back to you on buyback ROI, and the fact that we can actually determine in the same context of residual cash earnings whether you're better off keeping the cash that you have and waiting for a better opportunity, having the dry powder to execute when markets are better, or you may have opportunities now to start investing. And if you don't, having the discipline, if you don't see anything in the near future to invest in, then returning capital to shareholders is something that a lot of companies that adopt this measure end up doing if they can't, find better alternatives. But I don't know if you want to expand a little bit on buyback ROI, but I think that this kind of also speaks to that as well.
Yeah, sure. I mean, the decision to distribute should be based on sort of the business. And if you're in a business that's struggling and it's declining and there really aren't many investment opportunities, distributions should be an important part of your capital deployment. Whether you should pay dividends or do stock buybacks is an important decision, and that's why we created buyback ROI. We won't go into it again. We'll eventually do a LinkedIn Live specifically on dividends and buybacks. But buyback ROI basically is an ROI calculated based on the amount you spend to buy back stock, the avoided dividends if you're a dividend payer, and what the stock is worth at the end of a period. So if you buy back stock and the stock goes up, well, that makes you look good, right? You bought it back cheap, and then the stock went up. It probably went up more than it would have because you took out some shares and the value creation is being spread across fewer shares. But the same works in reverse. If you buy back stock at 20 and it drops to 10, well, your shareholders are really worse off because you bought out some people at a really high price. And when the value declined, the business, that was divided by that decline was spread across fewer shares. And so it declined probably more. And so buyback ROI helps us to sort of quantify the good or bad timing in buybacks and whether or not it was a good strategy. And we do it specifically as an annualized ROI because you can then compare it to the returns you're earning on your capital investments, your marketing investments, your R&D investments, and so forth. And so you get a much better way to do return-based comparisons of where your money's going to be best put. But the short answer is, if you're slowly winding down your business because you're in a very undesirable, sort of a business area, you have to find effective ways to distribute that money to the shareholders, because in that kind of an environment, usually if you make internal investments, you're going to wind up destroying value. Well, I think that's about it for what we have. I'd like to thank everybody who joined or who listens to this afterward on LinkedIn or on YouTube on our podcast. I really enjoyed the discussion with you, Marwan. And if anybody has questions, feel free to reach out to us. We're happy to answer.
Thanks for joining.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.